Without a doubt, Warren Buffett is one of the most influential investors today. With a net worth well past the $100 billion mark, Buffett is also one of the richest. And recently, he did an interview for CNBC to discuss the banking system, why he sold most of his bank stock, and how he is navigating this economic slowdown.
It's just amazing to me that banks could make presentations to financial house and everything, and if one bank bought a bond at 100 and another bought it at 96, and they both held a maturity. One bank carries it at 100 and the Santander Bank carries it at 96. I mean, it is accounting procedures have driven some bankers to do some things that may have helped their current earnings a little bit, and pretty soon, that everybody is in a position of looking at a number that nobody looked at when it was presented to them a year ago. If you read the 10K or anything, it was so. Well,
Buffett is telling us here is that there are some banks that are taking unnecessary risks in search of higher earnings. Not only that, but they are misrepresenting their losses with accounting tricks to make their earnings appear as good as possible. Normally, banks purchase government bonds with a variety of maturity dates as a way to store and grow their money. These portfolios are called hold-to-maturity portfolios. This is because banks would normally hold these assets until the bond matures. This gets them their money back, plus interest. The problem is that while the bond is maturing, their value on the market changes based on the current interest rate. This means that bonds can drop in value as interest rates go up. If the bank is low on cash, they might be forced to sell some of these bonds at a loss to make up the depositors' demand for money. The problem Buffett talks about is that these managers report their bond portfolio at purchase value instead of market value. So shareholders of the bank would be completely unaware if the bank's portfolio is carrying any losses. And if there's a bank run, these losses become quite evident.
But the banks did not call attention to what they were doing, what was going on, and I would read investor contact when they would have meetings with financial analysts, sure, the people follow banking, and nobody even brought up the point, virtually. And believe me, if we've got a $50 billion loss or something, and something can purchase, we would expect you. But people will know about it, and it's happened before. It's happened this time. It'll happen again someday.
Buffett makes a good point that if an institution suffers big paper losses, the shareholders should know about it. He says that if Big Share had a $50 billion loss like the banks did, he would be expected to let his investors know what's going on. And this is why, as Buffett explains, is the reason why he sold most of his bank holdings.
Did you see this? You were reading through the reports. You followed all these banking earnings that were coming in. So you noticed it. You sure I noticed it. Is that what you saw? That sold so many of the banks? Oh, we
sold a number of banks. I mean, we had held some of them for 25 years, but I don't like it when people get too focused on the earnings number and forget what my view with basic banking principle. I'm not going to get into any names or anything like that, but it happened to varying degrees throughout the industry.
Banks are becoming too focused on reporting earnings in the short term that they might not be paying enough attention to the long-term well-being of the company. And for that reason, Buffett has sold his stake in many banks over the last few years. As a matter of fact, Buffett has reduced his stake in pretty much every bank holding he had, except for Bank of America. Although Buffett is more cautious in the banking sector, he makes a point that the average American does not need to stress about losing their money in a bank failure. He says that banks might fail and shareholders might lose money, but depositors will never lose money. People
shouldn't be worried about losing their money in the deposits they have in an American bank. And today they have no reason to worry. But the message has gotten very confused, and people don't really understand how it all works. And politicians can make hay out of it. All kinds of things, bad things happen when people don't understand. Some major institution or new actually bears the costs and what the responsibilities are. And nobody is going to lose money on a deposit Buffett here
expresses his frustration with politicians and the media for blowing this small event out of proportion for their own agendas. But he reiterates that depositors are not at risk of losing their money, even if they have more than the $250,000 the FDIC guarantees. He even goes as far as to bet $1 million to anyone who wants to bet against no one losing their money in the bank failure over the next year.
I will be glad to put $1 million of my own money, anybody takes a differing view takes, and have them put $1 million in it at the end of the year from when we do it. If any American depositor has lost money from a bank failure, the other fellow gets to name where the $2 million goes to what charity. And if they have it, well, I warn him, and that's a firm offer, and we'll see who steps up. Right.
But if the FDIC and the federal government guarantee everyone's deposits, even beyond the FDIC insurance, wouldn't that cause bank managers to take even greater risks with their asset allocation, since they know that the government will step in and save the day anyway? You
give bank managers or CEOs the notion that all their depositors are going to be protected, then they're going to keep promising higher rates that they can't deliver. And they're going to do all kinds of things because they're not worried about their depositors anymore. But you've got an answer for how to deal with that. And so you got to answer. Absolutely. I mean, they've got to have something to lose themselves. I mean, in 2008, all kinds of trouble was caused by the banks. But no bank executive, that the CEOs have made those decisions. They all continued to live fine. You know, they may have lost their job, but they get their pensions so they bore no refund. And then the bank later would pay billions of dollars, a bunch of shareholders' money that had nothing to do with making those decisions. So I would absolutely suggest that anybody that's CEO of a bank that screws up and costs shareholders a lot of money, they go back to living, you know, like a person that works on the production line of Ford or something like that. They don't deserve anything special, and there's got to be consequences to the people who make the decisions. The answer is to have the board of directors feel, my God, if this guy screws things up, I've got to give back all this money that I've gotten, you know, $300,000 a year or whatever it may be, and pre-stock, and if God, so I got to give it all back for 5 years. Believe me, that changes behavior of the people that caused the problem. And this system doesn't get rid of moral hazard because it penalizes different people and make the decision. I want to penalize people who make the decision, and I don't know anybody that went back to flipping burgers at McDonald's or something, you know, after they screwed up the system.
And this is something that was lacking in the 2008 financial crisis. Bank executives made riskier and riskier investments in the pursuit of higher and higher profits and not larger and larger bonuses, because they knew that they were not going to be personally liable for losing money. In fact, most of these executives walked away with massive bonuses for essentially destroying the world's economy. Joseph Cassano received $34 million in bonuses in 2008. Vikram Pandit was paid $10.8 million the same year, and John Thain spent $1.2 million to renovate his office during the economic turmoil. So this is one of the reasons why Buffett suggests having these executives be personally and financially liable for mismanaging the bank's assets. But we'll have to wait and see on that one. In recent weeks, most of these banks have suffered major losses in the stock market. So does this mean that these bank stocks are a good deal, now that they're down?
The regional banks right now, the First Republics and the like, a steal from a value proposition? No, they're not going to save the stockholder. I didn't say that the bud is saving the stockholder. I did saving the debt of the holding company. I don't have a big problem with people losing money because if they do dumb things, I mean, the depositors are going to get their money, and they got their money on, you know, in the case of the Silicon Valley on Monday morning, but they were sweating bullets all weekend unnecessarily. If it just if they just understood how the system worked.
Buffett is quick to say that these bank stocks are not a steal due to their price, because the FDIC and the federal government will only bail out the depositors and not the shareholder. So if banks continue to focus on short-term profits without giving much focus on the long-term, all the risk will be held by the shareholder. He also points out that most people don't actually know how the FDIC works. Many people believe that the FDIC uses federal funds to insure depositors' money, but in reality, it is the banks who pay into this fund to run the FDIC and protect depositors' money. And in this last clip, we'll hear how Warren Buffett is investing during this economic slowdown.
In terms of the potential for a credit crunch coming through what the banks are going through right now, there's been a lot of speculation about what that could mean to the economy. Is it going to mean a 0.5% hit to GDP? Is it going to mean a 1% hit to GDP? What would you guess? I would say...
But I've been in business running Berkshire for 58 years, and I've never found the economic forecasts of any use to the company. And all you have to do is keep running every business as well as we can, and we're going to keep plenty of cash on hand so that people can keep making intelligent decisions rather than those forced upon them. We don't make our decisions as to whether to own part of a company for the next 20 years. We don't have any idea what anybody's going to do next week or next month. And I was buying Berkshire between 1962 and 1965 of control. Didn't really have anything to do with all kinds of things wrapping into economic markets all the time, but we haven't changed our course, in 58 years, and each of one of my good businesses and run by people we like and trust and at a decent price, and we'll keep doing that, and we'll keep buying treasury bills every Monday, and we haven't missed a Monday yet, and we keep all our money short, we keep it in treasuries, and we'll just keep doing that. That's what we've been doing for 58 years, and I can't tell you what the Fed was doing when I was buying Berkshire day by day or week by week or month by month or year by year. We were buying Berkshire. So anything can happen, and we weren't prepared for anything, but we like to do things. Over time, we want to buy good businesses. It's that simple, and we always want to have money.
In summary, Buffett emphasizes that this banking crisis is quite small and not at all like the crisis of 2008, and Americans should not be worried about losing their deposits, but he thinks banks are not currently a great investment, and for this reason, he likes to keep cash around and continue buying the assets he believes will perform well in the long term. And if you want to learn Ray Dalio's thoughts on the US economy and where we are in this economic cycle, check out this video right here.